Welcome to the Opening Bell Report.
Okay, let's dive in. It is February 15th, 2026, and we are looking at a really fascinating analysis report that just crossed our desks. It's all about Robinhood, ticker symbol HOOD. And I have to be honest, right off the bat, looking at the headline numbers, it feels like I'm staring at a typo.
It absolutely does. If you're looking at it through a traditional value investing lens, it's a number that just makes you stop.
It really does. So let's set the scene for you. Robinhood is trading at $76 a share.
Right.
And the number that makes you do a double take is the price to earnings ratio, the PE. It's sitting at 37x.
37.
Yeah.
Which is high. I mean, there's no way around that.
It's incredibly high. Let's just put that in context for a second. You've got a company like Charles Schwab trading at a multiple of 22x.
And the big banks are even lower?
Exactly. The big legacy banks are down around 12x. So conventional wisdom, everything we've been taught says a 37x PE is a flashing red light.
It screams overvalued.
It screams, sell, get out before the whole thing pops.
That is the gut reaction. Absolutely. You see that number and your instincts just tell you to run. But that's exactly why we're doing this deep dive.
Yeah.
Because this new analysis report argues that reaction, it's completely wrong.
Wrong? How can it be wrong?
It's looking at the wrong map. The report makes this really compelling case that judging a stock by its PE ratio alone is a huge mistake.
A trap.
Really.
A trap.
In fact, they argue that despite that high price tag, that 37 multiple, the stock is actually mathematically undervalued.
Mathematically undervalued at 37 times earnings. That is a bold claim. It goes against pretty much every rule of thumb I know.
It does, until you add one more piece to the puzzle. It all hinges on one specific percentage, a magic number, the report calls it, that just flips the whole narrative on its head.
Okay, you can't just leave it there. What is the number?
52%.
52%. All right. Let's put a pin in that, because first, I want to understand the trap. Why is it's too expensive such an easy mistake to make here?
It really comes down to using the wrong tool for the job. The report calls it the amateur analyst mistake.
Okay.
Essentially, you have investors trying to judge a hypergrowth stock using metrics that were designed for, slow growth, mature companies.
So it's like trying to measure the speed of a jet with a bathroom scale.
Exactly. Or, and I love this analogy from the report, you can't evaluate a race car using the same criteria you use for a tractor.
I like that. A tractor is great, right? It's reliable, it does its job, it's strong, but it's not going to win the Indy 500.
Right. A tractor, like a big bank, is valued on stability. You buy it because it's dependable. A race car, on the other hand, is valued on one thing.
Speed.
Performance. And if you judge that race car on its fuel economy, you're going to think it's a terrible investment. You're missing the whole point.
So in this story, the big banks are the tractors.
They are. And Robinhood is the race car. And the mistake is looking at the PE ratio and saying, wow, this thing is inefficient.
When really it's just lapping the competition. Okay, so if PE is the wrong metric, the tractor metric, what's the right one? What's the race car metric? Because we can't just ignore valuation completely.
No, absolutely not. And the report isn't suggesting that at all. We just have to add another variable to the equation.
Which is?
Growth.
Yeah.
And that is where the PEG ratio comes in.
The PEG ratio. Price to earnings to growth. Okay.
Yep. And it's really the only way to get an apples-to-apples comparison between a slow grower and a fast one. It asks a simple question. How much am I paying for each unit of growth?
It balances price against speed.
Perfectly put.
Okay, let's do the math. I want you, the listener, to really see this, because this is the whole argument. We have our PE ratio, which we said was 37.
Correct. Variable A is 37. Now, we bring in variable B, which is that magic number, the annual revenue growth rate.
52%.
52%. And you have to understand, that is an elite number. Schwab is growing at maybe 5%. Interactive Brokers is around 12%. So 52 is just a different league.
It's huge.
So the formula is simple. You take the PE, 37, and you divide it by the growth rate, 52.
Okay, so 37 divided by 52, that's definitely less than 1.
But 0.71.
0.71. Okay, so we have a number. For anyone listening who doesn't live and breathe this stuff, what is a good PEG?
Yeah.
Is 0.71 good?
It's fantastic. The rule of thumb is pretty simple. A PEG ratio of 1.0 is considered fair value.
Meaning you're paying a fair price for the growth.
Exactly. Anything over 1 starts to get expensive, and anything under 1 is considered undervalued.
Wow. So at 0.71.
It's deep value territory. The report's conclusion is that Robinhood is cheap relative to its speed. Yes, you're paying a premium on the PE, but you're getting so much performance that the price is actually a bargain.
So you're buying a Ferrari for the price of a BMW.
That's a great way to put it.
Okay, but I have to play devil's advocate here. Growth is great, top line revenue is sexy, but is it profitable growth? Or are they just lighting cash on fire to get users?
That is the billion-dollar question, isn't it? Is this hype, or is the business model really solid? And that brings us to the next section of the report, quality of earnings. This is where we look under the hood.
And usually with banks, the quality comes from their physical footprint, branches, ATMs, that sort of thing.
Which are actually liabilities in this day and age. They're expensive. You have rent, staff, security. It's heavy. Robinhood is asset light.
It's all digital. They're basically a software company.
They're a software company that happens to be a brokerage. And because of that, their margins look completely different. The key metric the report points to is the free cash flow margin.
Okay, just so we're all on the same page, free cash flow is the actual cash left over after you pay all the bills. It's the real profit.
The walkaway money. So let's look at the competition. Charles Schwab has a free cash flow margin of around 20%.
20 cents for every dollar. Not bad.
Not bad at all. Coinbase is a little better, around 25%. Respectable businesses.
For sure.
Now look at Robinhood. In this most recent period, their free cash flow margin is 35%.
35%. So for every dollar that comes in, 35 cents is just pure cash profit.
Correct. That's getting into like Visa and MasterCard territory. That is not normal for a brokerage, and that is why the market is willing to pay a premium for those earnings. They're stickier.
What do you mean stickier?
Think about what it costs to add a new user. For Robinhood, if they add 1 million users, their costs barely budge, maybe a bit more for cloud storage.
Right.
If Schwab adds 1 million users, they might need to hire more support staff, maybe even open new branches. The cost to scale is totally different.
It's a difference between a tech valuation and a bank valuation.
That's it, exactly. It's operating leverage.
Yeah.
And the market is paying up for a business that scales like a software company, not a regional bank.
Let's go back to that racetrack analogy. The report has this growth gap concept I want to touch on. It visualizes the race pretty clearly.
Yes, it lays out the choice for an investor perfectly.
Okay, so in lane 1, you have Charles Schwab, the safe choice, trading at 22 times earnings.
But only growing at 5%. That's the sedan. It's safe, you'll get there, but it's low cost, low speed.
Then you have, say, Interactive Brokers, the pros choice. They're trading at 18x PE, so they look like a value play.
Right, but their growth is 12%. So moderate speed, moderate price. Good, but not spectacular.
And then you have Robinhood, the high sticker price at 37x PE, but with 52% growth.
So this is the trade-off. This is the math the smart money is doing right now. You can pay 22 times for Schwab to get 5% growth. Or you can pay, 15 points more on the multiple?
And get 10 times the growth rate.
10 times the growth. Suddenly that premium doesn't look so expensive, does it?
When you frame it like that, it seems obvious. The growth gap is it's massive.
That's the whole argument. The report says this is why institutions are re-rating the stock. They're realizing that looking at PE in a vacuum made them miss the best growth story on the board.
But I have to ask, why now? Why is this happening in February of 2026? Robinhood's been around. What's the catalyst that's making the model click today?
It's all about that operating leverage finally kicking in. The report calls it the snowball effect.
Because for a long time, people said it was a one-trick pony. All about trading volume.
That was the old story. But look at the revenue drivers now. It's not just trading anymore.
Right. You've got the gold subscriptions.
That's recurring revenue. Super high margin, very stable.
You've got IRA matching.
That creates stickiness. You don't move your retirement account every 6 months. That money is locked in.
And then the more advanced stuff like derivatives and futures.
Higher fees, higher engagement from their power users.
And the big one they just launched, the credit card.
That's the game changer, according to this analysis. Because it puts Robinhood in your actual wallet. It creates this flywheel. You trade on the app, spend on the card, save in the IRA.
And because the cost to run the app is basically fixed.
Every one of those new products is almost pure profit. That is operating leverage in action. The snowball is getting bigger and rolling faster.
And the report projects what this does to the PE ratio, right?
Well,
because if the earnings, the E explodes.
The PE has to come down. It's just math. The report projects that if this growth holds at the current stock price, the PE will drop to around 20x by next year.
Wait, 20 times?
Roughly 20x, yes.
That would put it at a lower valuation than Charles Schwab is at today.
Exactly. And that's the really mind-bending idea here. The thesis is that by buying the expensive growth stock now at 37x, you're actually buying next year's value stock today.
We're getting ahead of the curve, buying it before the market realizes it's become a value stock.
You're buying the transformation itself.
Okay, we have to talk about the risks. This sounds great, but what could go wrong? What breaks this whole thesis?
The report is very clear on this. The bear case hinges entirely on that growth rate.
If the race car slows down.
Precisely. If that 52% growth falls to, say, under 20%, maybe a recession hits, maybe regulators crack down, then the whole story falls apart.
Because then you're paying 37 times earnings for 20% growth. Your PEG is almost 2.0.
And that is expensive. The car is no longer worth the sticker price. The whole thesis relies on that engine continuing to roar.
So that's the big risk.
It is. But The report's base case is that growth can stay above 40% because of that product flywheel. And as long as it does, the PEG stays under 1.0 and the stock remains, by their math, cheap.
And they put a number on it. The report has a price target.
They do. Based on those projected earnings, their final price target is $133.
$133. And we're at, what, $76 today?
It's nearly a double from here. The report flat out says the current skepticism around the PE is a gift for investors who understand the PEG ratio.
A gift. Those are strong words.
Very high conviction.
It really makes you rethink the whole definition of value investing, you know?
It does.
We're all taught the Warren Buffett way. Buy solid companies for less than they're worth.
The Ben Graham School.
Yeah.
But in 2026, in a fully digital economy, does that old definition still work?
That's the question, isn't it? Does value look less like a bank vault and more like a software subscription that can scale to infinity with almost zero cost?
Exactly. When you can add 1 million customers without building a single new building. Yeah. Maybe our old metrics for what expensive means are just outdated.
Maybe value just looks like code now. It's something to think about. Next time you see a stock with a high PE, maybe don't just dismiss it.
Pull out the calculator.
And check the PEG.
Always check the PEG.
A fascinating deep dive. Remember, none of this is financial advice. We're just digging into the analysis to see how the arguments are built.
Do your own research, but make sure you're using the right math at the job.
Exactly. Thanks for listening to The Deep Dive.
We'll see you next time.
Don't forget to like, share, and subscribe for more.